Okay, this is performance of markets. This is as of September 30th. We're about a month on from that, and look at the red. Look at the red, right? Look at this. This is the past year in markets. U.S. stock market down 17%. This is September 30th, right? Again, a month ago. I just, we don't have the updated version of this. International developed stocks down 24%, we'll call it. Emerging market stocks down 28%. And remember, we have a very strong dollar right now, which is impacting dollar returns to U.S. shareholders in international companies, exacerbating the downward move. So some of this is going to be the very strong dollar, right? If you go to Europe now, it's a really good time to go to Europe, right? Rolf and Charlotte, you spend time in Switzerland, and your dollar's going a long way now, isn't it? Yeah. So it's time to spend in Europe because the euro has weakened dramatically. All European currencies have weakened versus the US dollar. Global real estate down 20%, and then look at the bond market. Even the bond market, US bonds down almost 15% at the end of September. Now, this is an intermediate duration. This is shorter term bonds have not done as poorly. Longer term bonds have done worse. And then here's global bonds. Global bonds have actually been a good source of some stability for investors. But you can see this is what the last year has looked like. Let's move on to equities. What has been the picture of the equity markets? I've talked a lot in recent years about value versus growth. And I told you for quite a number of years that value was poised to outperform growth stocks, even though during the pandemic, people were buying growth stocks like crazy. They were buying Peloton, shares in Peloton, when everybody was going to ride their bikes. And they were buying shares in Netflix. And what life was going to be like is you were going to sit on your stationary bike and watch Netflix and Zoom into work, right? And Zoom stock went up. I was going to make some slides. I ran out of time to show you what those stocks have done. They have been destroyed. And when I say destroyed, I mean down 80%. If you had been suckered into that trade, the growth stock trade during the pandemic, and if you had said, oh, I gotta buy Peloton, and I gotta buy Zoom, and I gotta buy Netflix, and these stocks are, you lost your ass. And I gotta buy cryptocurrency. You got destroyed. And in fact, what we've seen is that value, which was trading at a big discount to growth stocks, has outperformed. Doesn't mean it's been positive, right, this year, over the last year. It just means you've gotten some protection, because look at what's happened year to date. Growth stocks, 25% down, 27% down. These is large, mid, and small. Value stocks outperformed here by, 14% and 13% and 12%. I'm sorry, 10%. So very substantial outperformance, but still negative, right? So you got some protection from our portfolios, quite a bit. What we're seeing as we meet with clients and look at performance returns is that the portfolios we've given you have given you roughly 3, 4, 5, in some cases upwards of 8% outperformance versus the market. So I'm proud to give you and happy to give you that news. We have given you defensive qualities in your portfolios, but we have not been able to avoid, this completely. But I'm very happy with the defensiveness that we put in making sure that we were tilted toward less expensive stocks and not getting hit. We didn't want the car to be totaled, right? We've got some dents in the automobile, but car wasn't totaled. And you can see that since the market peak in February of 2020, right before the pandemic broke out, that you can see that large growth stocks, the Apples and the Microsofts and Googles, these big growth stocks have done very, very well. But in other areas, look at this. Small value companies, 18% returns versus basically flat for small growth companies. 13% returns for medium-sized value companies versus 4% for medium-sized growth companies, right? And since the market lows, same thing, outperformance by value. So people were looking at me for a while going, but price is what determines so much in our business. What you pay for something is critical. And people were way overpaying for growth stocks. Where are we today? This is as of October the 25th. Things are reasonably priced based on average PE ratios over 20-year average PE ratio. Value is still a little bit cheaper than 20-year average. Growth is a little bit higher, except for this small growth, because small growth companies actually sort of look like a bargain right now at 65% discount to 20-year averages. So they've been hit so hard, right? They've been hit so hard that they actually now look reasonable. This is the S&P 500 intra-year declines against calendar year returns. And what this, I always show this slide, you have to expect that almost every single year, the market at some point in the year, the red dot, at some point in the year, the market will be negative. You'll have some negative points during the year. This is where the year ended, right? So in this year, whatever it is, 1995, the market ended up 34%, but at one point during the year, it was down 3%. And so what the red dots are showing you is that, you know, if you're going to be an investor in the stock market, and this is the S&P 500, you have to expect there's going to be some negative. And some years it ends negative. So in this year, this was 2008, undoubtedly, the market ended down 38%. And at one point it was down 49% that year in 2008 during the financial crisis. And where are we this year? This year, we're down 19% on the S&P 500. We've seen lows as low as 25% down this year. So we're not down as far as we've been at the lows, but we may end the year down for the year, and that will be okay, because you see, it happens. It's just the way it is with investing. This is the S&P 500. Where are we as of October 25th, just a couple days ago? This is going back to 1996, and you can see peaks and valleys. And where we are is right here. We are trading at about 16.4 times earnings on the Standard & Poor's 500. We are down about, again, 20% from the peak. And at the peak, things were trading at around 21.4 times earnings. So we are cheaper. 16.4 times earnings is cheaper than 21.4 times earnings. It's a better deal if you're an investor. It implies higher returns. Could it go lower? Could go lower. Could go higher? Could go higher. It's gone higher in the last week. Who's noticed the market has really firmed up over the last few weeks? I think we're up 5, 6, 7% returns over the last. So this is how it goes. Nobody knows where it goes next, but this is where we're at, 16.4, much more reasonable valuation than 21.4. And everybody's watching earnings get released right now in this week. And some are having good returns, like Coca-Cola's got good returns and PepsiCo's got good returns because people are still drinking soda and eating chips. But, you know, Google missed, and I think Microsoft has missed. And the big tech companies they're sort of not, sort of a different phase right now than it was a couple of years ago. Okay, and then where are we on so here we are, the 10-year Treasury now is at 4.1% versus where were we in January of this year? In January of this year, the 10-year Treasury was 1.6%. It's now 4.1%. I can't tell you what a huge change that is. In the bond world, it's like two different planets. And the results show in the decrease in the value of assets. The higher the interest rate goes, the lower all assets. And I mean all assets. It doesn't matter if it's stocks. It doesn't matter if it's bonds. Real estate is going to be valued less. Inventories are going to be valued less. That's just what it is with higher interest rates. The interest rate is the rate we use to discount all assets. So all assets are pension funds, anything, you know, collection of tables. Everything is going to be worth less in a higher interest rate environment. In January of this year, again, 21.4 times earnings. We're now at 16.4, and the dividend yield hit as low as 1.3% on the S&P 500. You're now earning 1.8%, right? Because if the price of the S&P 500 goes down and the companies in the S&P 500 continue to make the same dividend distributions, your distribution rate is higher. So you're now getting a higher rate on the S&P 500. And in international stocks, the international dividend is 2% higher than the 1.8%. So international stocks are yielding 4% on their dividend yields. Very high. This is showing you the valuation measure of expensive or not expensive on the S&P 500 versus a 25-year average. So the 25-year average of the price to earnings ratio is 16.85. And I want to just, Catherine, is it go? Am I going? If I point like this, can the folks at home see what I'm doing? Okay, so I'm not writing on the thing, so I just want to make sure that I'm clear to them. We have as many people tuned in remotely today as we have in the room, so I want to make sure. So this is the 25-year average of the price to earnings ratio, the forward price to earnings ratio. That's important that it's forward and not backward looking, because that's taking what the analysts are looking and estimating of what company earnings are going to be, right? Which is more important than what they were, because everybody wants to know what they're going to be. And so we have all these analysts whose job it is to go around and figure out what's Coke's earnings going to be, what's Microsoft's earnings going to be, and they study it and so on, and all that gets put together into a big pot, and that's called the consensus estimate. And so this is the forward price to earnings average is 16.85, and you can see where are we? We're just a little bit below that. So is the market extremely expensive based upon the analyst estimates? No, you can see it's not. It's come back, but look where it was, right? This is where it was. So we had some valuation concerns, and we talked about that quite a bit. Now, could it get cheaper? Well, you see, look at that. That's 2008, got really, really cheap. So, you know, that was a liquidity crisis. That was a full-on financial crisis across the world. And, you know, I'm not predicting that, but we've seen it. But we're not near these sort of nosebleed levels anymore in valuation. And that's why I say to people and have been saying to clients, enjoy 2022. I know portfolios are down, but when I say enjoy it, I mean it's good to take a breather from this kind of overvaluation. It's needed to be able to set up for future gains. If we don't come off of that, it's dangerous territory to be an investor. So we take some pain in 2022. We wash people out of the market who learn a lesson about Bitcoin and Peloton and Netflix stock. Oftentimes it's the younger generation that has to learn the hard way that there's another side to the risk coin. And that's what it's been, you know, and then they learn, you know, diversify, set your financial goals, have a prudent allocation. As I said, that's staying the course. Staying the course isn't just chasing things because somebody puts it in the news. Any questions about this? We're averagely priced right now on the U.S. S&P 500 stock market. And then one more thing on the S&P 500. This is this penumbra here. This is the spread between expensive stocks and inexpensive stocks. And you can see that where we hit recently was this way expensive overvaluation, right? And look how it's come down. Look at this drop. And so the top end of the market, Peloton, et cetera, got crushed. You can see that's the crushing that they took. Whereas back earlier, this is the less expensive value side of the market. It's gotten cheaper. It's gotten cheaper as stocks have fallen this year, but not nearly the pain of this. Does that make sense, everybody? Am I explaining this all right? This is the dispersion, and then this is the average. There's your 16.8 again. What's it look like in the international world? Well, international stocks have continued to get cheaper versus U.S. stocks. And a lot of clients are like, why do you believe in international stocks? It's simple. because there's great companies all over the world. That's just how it is. I don't look at it as international stocks. I look at it as great companies that are located in other parts of the world, whether it's Samsung or whether it's Mercedes or whether it's, whatever, Royal Dutch Shell or LVMH or Coca-Cola de Mexico or Bank of Montreal. The US does not have a lock on great companies. They're all over the world. And if we don't invest in those companies, then we don't have a full investment picture. And it just so happens they're really selling cheap. They are selling at a 32% discount to the price of US companies just because they're located in other parts of the world. Just because. Jack. Yeah. Yeah. So international stocks as a percentage of the valuation of US stocks has now broken through 2 standard deviations. It is now 2 standard deviations cheap. This purple line right here, right? So when we get to extremes of valuation in finance and in markets, we look at it in terms of standard deviation. Here's the average, here's the first standard deviation. And October 25th, we are now historically at very, very inexpensive levels for international companies versus US companies. And that's why I continue to believe is a really important area to be invested in going forward. It's cheap. Here's the dividend yield, the difference in the dividend yield. And I told you the difference in the dividend yield between US companies and international companies is 2%, and there it is. It's at 2 standard deviations, and it's going back to 2002, it's the highest it's been. The difference in the dividend yield. So you're getting paid a nice healthy dividend to hold international stocks as well. They tend to pay higher dividends internationally than in the US. And then finally, well, okay, what do we expect for growth? Well, it's different than the US. So this is expectations for 2022 growth, 2023 growth, and 2024 growth. And so the estimates are that we'll see growth going forward for the US. Here's China. They're expecting a big, big surge in growth in China. Here's Europe. You see we're getting the effects of the war in Ukraine, but then we expect a big rebound in 2024 in Europe, up to 12% growth, a big rebound there. I'm sorry, there's Europe. This is emerging markets. Europe is here, but also going to see this rebound and also growth. So we see growth going forward while things are falling off right now. And then over here, we can see the valuations. They're at this diamond is the current, I'm sorry, the current is, I can't tell the difference between the purple. That's dark purple. So the current is this sort of lighter purple triangle. And you can see we are at the lower range of valuations on international equities. So when you look at your portfolio and you say, I got losses in this international equity portfolio, get rid of that. If you tell me to get rid of it, I will get rid of it. But I will tell you, you're getting rid of the least expensive companies that are great companies in your portfolio. And it's nothing I'm doing in my own portfolio. And so we continue to invest internationally. And then you can see that there are periods where the US outperforms, which is in gray, and then international stocks outperform. So you see that going back to the 1970s, there have been periods, especially here in the 1980s, of very strong outperformance. We've had a very long period of US outperformance versus international stocks. But that doesn't mean that that has to continue. And given where prices are at, it may not continue. One more slide on equities, consumer confidence in the stock market. This is showing you that when we hit lows in consumer confidence, and we are at a low in consumer confidence right now. There it is. Look at that. When we hit a low in consumer confidence, what do we get? What happens after we get this? What's one of the indicators we get when we get a low in this reading of consumer confidence? Average subsequent 12 market S&P 500 returns from the trough. 24.9% returns on the S&P 500 on average, from these troughs that are hit when everybody's consumer confidence is terrible because right now we have high inflation, we have had very, very strong returns to stocks following those troughs. It's a counter-cyclical thing. The prices get pushed down and people buy, and confidence changes. In bonds, this is the Barclays aggregate, which is, think of it as the S&P 500 of bonds. That index, the aggregate index, contains treasury bonds, it contains mortgage bonds, it contains corporate bonds, right? So it's the one index that people look at in bond world and benchmark against, and we do too. It used to be known as the Lehman Brothers Aggregate Bond Index. Lehman Brothers is no more. Barclays bought the business. It's now the Barclays Aggregate Bond Index. It has an intermediate duration, so it's not super long-term bonds and it's not super short-term bonds. It's intermediate-term bonds. And so it is just like stock portfolios tend to get benchmarked against the S&P 500, bond portfolios tend to get benchmarked against the aggregate index. And you can see that in bonds going back to 1976, just about every year there have been positive returns to the bond index. Sometimes very, very strong returns, 19% return, 33% returns back in 1982. That was the year when inflation got under control. And everybody who owned long-term bonds saw them rise in value tremendously. But as with the other slide I showed you, each year you could have some negative periods during the year where the aggregate index trades at a loss. But it's not nearly the losses that you see in the stock market because it's bonds. It's not as volatile. But you see 2%, minus 5%. Where are we this year? Look at this year. If you want to see one slide that shows you what's happened to bonds this year, this is the slide. Look at that. Really something else. Down 16% year to date, and at one point down 17%. That doesn't mean that all bonds have been down that much, and we have managed to protect your portfolios from this because you may recall we began to move bond portfolios shorter term and have kept portfolios shorter term. We have losses, but our duration compared to the aggregate bond index has been less. For example, the aggregate bond index has had a duration, meaning think about it as maturity of the aggregate bond index has been running at 5 or 6 or even 7, and our bond portfolios have been running at 3, half the duration. And so we've been able to give you some protection as well in bonds, just as we have done in stocks. The Treasury yield curve. This is amazing. This is an amazing, amazing slide. And what it is showing you that less than a year ago, in December 31st of 2021, these are treasuries. The 3-month treasury yielded just about 0%. This is where the Fed has some control. Fed doesn't control directly rates out here. This is 3 months. This is 30 years. This is a 30-year treasury bond, a 20-year treasury bond, a 10-year treasury bond, and so on. And look at the difference between then and now. And this is what has happened here in 2022. Interest rates have reflated. Now, I could say big time. It really doesn't do justice to it. We're talking about an epochal change in interest rates. Epochal. As the world comes out of this period of super low interest rates that we entered back during the financial crisis, and the central banks of the world continued to provide liquidity, and low interest rates in order to keep the world from going into another Great Depression that eventually would lead to World War II back then. And so that was really what central banks have been trying to do, is avoid World War II. And what do we get? Vladimir Putin deciding that he's just not going to play along. Really, which to me is despicable. Despicable. I was a Russian studies major in college, and I just can't tell you how despicable it is that a country that was allowed to trade with the rest of the world, invited to trade with the rest of the world, did trade with the rest of the world, decided it wasn't going to play by the rules and was, you know, we're going to launch a war and a big one. So look at the change. A 3-month treasury bond that was yielding nothing now yields 4.5%. You can get 4.5% interest on a 90-day treasury bond. And that's the work that JC and I have been doing, is getting you that and moving your portfolios into that, because you can see that, look, you're getting paid actually a higher interest rate on shorter term bonds than you are on these very long-term bonds. Now, if interest rates fall, if we get a recession and the Fed lowers interest rates, you know, you may want to hold these longer term bonds, but we're not messing around with that. We think these could go higher. They might. But you see that these interest rates are available in corporate bonds, in mortgage bonds, and all of it. And so we have been moving the portfolios toward those areas to take advantage of these shorter term interest rates. Any questions about this yield curve? Incredibly, incredibly important graph. Good? Enormous implications, just beyond. Here is the federal funds rate, the Fed funds rate, which is controlled by the Federal Reserve. That is the rate at which the Fed loans to its member banks. And you can see since 2000, look at this, you know, up again, right? And then we have the financial crisis, and then they're just plummet. And look where rates have been. Look where the Fed has held rates from 2010. 2016, they started to raise them again. And then what happened here? Why did they lower rates again? COVID, right? Remember in March of 2020, the Fed just absolutely dropped rates through the floor to stop the world from coming to a stop, and flooded the market with money. And look at that drop right there. Huge, massive drop. Here were the drops during what? This was the financial crisis. And look at the size of these drops at each of their meetings till rates got to be zero, and they began to stair step up, and COVID broke out. All right, and here we are. And then this is where expectations might be. This is where the long-term target for the Fed funds rate, that's what they articulate, 2.5%. But we're a long way from that, right? I mean, 3.13 is where it is, and this is where the market is expecting, and the Fed has said we're going to go. Why? Why is the Fed doing that? If this is their long-term goal, why are they doing this? Why are they saying we're going to go to 4.6 and all this? Inflation. We're going to break inflation. And we're serious. We're not playing around. And they're not. That's where the Fed funds rate is. And so that's why these treasury rates, which usually are higher than the Fed funds rate. The Fed funds rate is a very short, it's like an overnight rate. It's what the Fed charges to JP Morgan to lend JP Morgan money for 24 hours. So if it's a 3-month loan, while that sounds like a short-term loan, it's nothing compared to the 24-hour loan that the Fed is giving at 3.13 to JP Morgan or whatever bank here in Texas. So that's why these short-term rates have become so elevated, right, for treasuries. Okay. It's affected all bonds. Here's the muni bond curve, right? So this is a tax equivalent yield curve. If municipal bonds, which are tax-free to all of you, and we hold municipal bonds for all of you. And by the way, munis have done, relatively speaking, great this year compared to treasuries. Muni bonds, and we do hold muni bonds for a lot of you, have really held up well. What you can see here is on a tax equivalent basis, muni bonds are yielding 5.4, 5.5. I mean, these are real interest rate numbers. We've just left a world where things were yielding just about nothing, and we've woken up again. It's like, oh, I get paid interest on my money. So That's nice, right? For the group in this room. We're investors. We like to get paid a return if we buy an investment. And so that's the pain we're taking in 2022 to get back to this. And really long-term municipal bonds, 7.5%. Again, that's the tax equivalent yield. That's not the actual yield. This is saying if it was a taxable bond, this chart is trying to show you, because treasuries are taxable, if the muni bond was taxable, what would its equivalent yield be? And it would be 7.5% versus 4.5% for an equivalent treasury. In other words, you can buy a 20-year municipal bond and get paid the taxable equivalent of a 7.5% yield versus a 3% above the US Treasury. So we're back in a world of real, real yields and real interest after this weird 10-year period. And you can see that state and local debt's pretty much in control. Where the federal debts have soared, we know that, state and local positions are reasonable. This is all sorts of different bonds. Why do I keep talking bonds? Because we're in the fixed income portion of the talk, and you can see US Treasuries, and where are yields? Well, all of these current yields, which is this purple diamond, are toward the very top of the 10-year range. Again, we've been in this 10-year period where interest has ranged. Here's US Treasuries. Interest has ranged from, 0.5% up to 4.5%. And where are we in that range? We're in the top range. We are at near all-time 10-year highs for yields across just about every bond that you can name, including international bonds. US high yield bonds, 9.5%. Leveraged loans, which are bank loans made to companies. So it's a form of a loan that is usually securitized, 11%. Serious interest rate payments now that are being made. All the academic studies show that nobody knows where the next move on any price is. Nobody. They've studied this up, down, and all around. Nobody can predict the next move in a stock price. Nobody can predict the next move in an interest rate. Warren Buffett himself has said, I just don't even look at interest rates when I invest. It's just not a factor. I'm looking for great companies at a great price. There's some background information about interest rates. And he has also said that if the Federal Reserve Chairman whispered in his ear what the next move was going to be in interest rates, wouldn't affect a thing he does, because he's investing for the long term. So we could see higher prices on bonds, meaning, we could see higher yields on bonds and lower prices. Could prices go lower? Yeah, they could. And yields could go up from here. We could break through these already high elevated levels of yields. But we have to keep in mind the prior 10 years have been abnormal. Although what's normal? What's normal? We're talking about economics and investments and time and money. What's normal? You could argue there's no such thing as normal. There are averages. I don't know if that's helpful, but Kurt's point is, we could see, but he also said that their focus there is on investment grade credit. He said they're overweight investment grade credit. Well, what's investment grade credit? IG corporate credit, investment grade credit. Treasuries are investment grade. A lot of municipals are investment grade. A lot of mortgage-backed securities are investment grade. So what he's saying is they're overweight this. In other words, they're happy to own these bonds at these high yields in their portfolios, and we are too. So I would concur with that. It doesn't mean the yields can't go higher, which would mean the bonds get cheaper. And inflation is going to have a lot to say about that. Okay, as we come to, how am I doing on time? Okay. Unemployment and wage growth. This is a very interesting chart to me. If we see the 1970s, and so wage growth is purple and the unemployment rate is gray, and we can see that back in the 1970s, for the most part, wage growth exceeded the unemployment rate. That's sort of stands out as you can kind of see that. And then what happened in the 1980s all the way through really the current day? The unemployment rate stayed, for the most part, except for a few periods, above wage growth. This has incredibly huge implications for how people feel about the economy, right? Unemployment on the higher side, wage growth on the lower side, and you got a lot of angry Americans, ready to pull the lever for whatever is going to fix that. Well, this is COVID, right? And the unemployment rate shot up here because people were getting laid off. Service workers and restaurant workers and just all kind of people were getting laid off. But look how it plummeted quickly. And most interestingly, we now have this period here where, for the first time in decades, we actually have a reading where wage growth exceeds the unemployment rate. We have this very, very low unemployment rate, and we actually are seeing some wage growth. And so I think that when we think about elections, we really don't know what the effect of this is going to be. When someone gets into the voting booth and they're given a choice to do away with this, so to speak, they're given the choice, okay, I'm going to maybe go back to a period of higher unemployment and lower wage growth. I don't know they're going to pull the lever that way. We'll see. But this is a very, very interesting data read to me. It's the closest thing to it. You'd have to go back to where? 1980 to see a period where wage growth exceeded the unemployment rate. 40 years ago. This has been a long, tough drought for American workers. And there is suddenly a glimmer of hope. See what they do with it. I wouldn't trust all the polls right now, because if there's one thing, I know inflation's a big issue, but if you have a job, you have a chance to deal with inflation. If you have no job, you have no chance to deal with inflation. So I'm just throwing that out as I think about elections. There was a hand up, I think. No? John. The question for those at home, John's question was, what percentage of people know this condition? And I doubt that it's a very high percentage. People know their own personal situation. People are working now, and people are getting growth in their wages. They're also getting high inflation. Everybody's going to balance those two things really in, I think, very personal ways. They're going to balance it in person. Some people are going to go in and say, I'm working now. I value that a lot, and inflation's impacting me, but I put my employment situation ahead. And we have to remember that the mandate of the Federal Reserve, the famous dual mandate, is to control and to target both inflation and unemployment. It's a very wise design, I think, that was designed into the Fed around 1913, I think. That the monetary policy of the country has to target both of those things for very, very good, wise reasons. If you don't have a job, it's the most devastating thing. You are powerless. There's unemployment insurance, but it can never make up. And so people are working right now. It gives them a fighting chance to deal with inflation. High unemployment, you don't have a chance to deal with high inflation corresponding with unemployment. So just wanted to show everybody that slide. And here we can see other readings on jobs. This is job openings to job seekers. Very high period. We've backed off some, but very high ratio of openings to job seekers. We know that, right? It's kind of hard to get things done and fixed these days, and at least in my world. Layoffs, really low readings on layoffs. Companies are not laying off workers, which is good. I want to keep them. Quits are up. People are quitting. There's all this like silent quitting, quiet quitting, and there's different kinds of quitting now, I'm told. You can quit loud, you can quit quiet. Right? So many quittings that people are coming over different ways to do it. I've heard some where people are working remotely and like they're working 3 jobs and they've actually quit one of them. They quit doing work for one of the jobs, but they're getting paid. So that's like, it's like a 2 and 3 quit. You quit from 2 of the jobs, but are getting paid and working one of them remotely. I mean, just all sorts of stuff like that. And then of course, here's inflation. And, look, what can you say? It's a high reading. It's not the highest we've ever seen since the 1970s. Of course, we saw these really elevated peaks. But it's very dramatically higher. It may have peaked. This is the highest reading we've had. That was in June. And you see, we've had a succession of falling values. And that's how things go. Things in an economy this big, we don't go from 9 to 2 overnight. Nothing does that, not even interest rates this year have had that, they've gone up for sure. That's the closest thing I know is the rise in interest rates this year. But you see, we may have peaked. A guy I really like and read a lot says we've peaked. We may have hit peak inflation in the US, and this sort of makes that argument. We stair-stepped up and we've gotten lower readings, and the components here are different too. You can see that the very high energy prices that prevailed around the invasion of Ukraine have narrowed, right? And we can tell that at the pump. And then this is energy prices. So still high energy inflation, but not near what we were getting for readings earlier. New and used vehicles is the red, right? It's hard to get a car, but now we're seeing less pressure, upward pressure on prices. Let's see, too many purples. This is food at home has actually been increasing. Grocery stores have been increasing. This is other restaurants kind of have stayed the same in their inflation levels, and shelter, the price of shelter has been going up pretty. So the components that are contributing to higher inflation have been changing. The composition has been changing, but we may have peaked. We may not have. Don't know. Here are inflation expectations. And we've got 3 different ways to look at what are the expectations, both from consumers, professional forecasters. These would be survey type instruments. This is 5-year inflation break even. Who knows what the inflation break even is? The test. Anybody know what the inflation break even is? Well, we did not have anything called a Treasury inflation protected bond the last time that we had a huge outbreak of inflation in the 1970s. Inflation protected bonds were actually invented by which country? Anybody know? The country of Israel. In the 1960s came out, I think, with the first formal inflation protected bond. It was called the Galil bond, and named after the Sea of Galilee, that area. And Israel had very high inflation. It was a young state that had trouble getting products. There were embargoes out of Europe and so on. And so the Israeli government had to give a guarantee against Israeli inflation, and they invented the inflation protected bond government. The US Treasury did not issue inflation protected Treasury bonds until the late 90s. So in the 1970s, okay, so what is the break even? That is simply, this is the difference between the 5-year Treasury bond, right? There are 5-year Treasury bonds, and the 5-year inflation protected Treasury bond. That's the break even. And that tells us, that gives us a market derived way to see what are inflation expectations over a 5-year period. That's the break even. And you see that regardless of which of these methods, sort of direct polling, what's interesting and what's important about an inflation break even is that the Treasury market is so deep. There are so many investors all over the world. You're getting kind of a market-based forward expectation on inflations. And you don't see 4% and 5% and busting the y-axis. You are seeing, and we've been consistently seeing long-term expectations, although they've recently been higher, in the 3% area. That's a market-derived rate using an instrument that is heavily traded, U.S. Treasury bonds. So we'll see. Could go higher, but if you're expecting 8%, that is not what the Treasury market is expecting, and those who participate in the Treasury market, they're not seeing that kind of high inflation going forward. And that's what I would have to bet on if I had to bet on anything. Oil markets. If you had said in, here we are, we're right here, a little north of $80 a barrel, but if you had said on February the 25th, the day after Russia's invasion of Ukraine, I got to own oil. Russia has invaded Ukraine. I have got to own oil. I got to have it in my portfolio, pure oil, commodity ownership of oil, because forget it. We're going to 500 a barrel or whatever. You sort of lost a lot of money this year. So be careful. Markets have a way of looking into the future, and things like that can bite you because you lost money. The oil price is now down below where it was the day before the invasion of Ukraine. And yet you would have had a perfectly cogent argument the day after the invasion, I've got to own oil. And we've had shutdowns of pipelines and embargoes, and they're trying to figure out how to cap the price of Russian oil, and yet we are lower now than we were before the invasion. Global inflation. So this is going back in time to 2009. These are countries on the left-hand side, and you can see that it's just all, these are readings in October and September, and it's all red. This inflation is a global phenomenon. You can blame the President of the United States if you would like, but you will need to blame every single president of the United States. Right? It's a global inflation. It's clear. Should be clear. There are some places where inflation is low. Japan, I think. Japan always has low inflation, but I don't know why. Oh, here it is. Japan's only reading 3% inflation, which is higher than it usually does. So there are some anomalies. Global economic activity. Are we going to have a recession? Is it going to be a global recession? Well, recently, in all of 2022, you see quite a bit of green. It's not like the pandemic right here, right? Or the global financial crisis here, where it's all red. You see things are kind of mixed, but mostly green. It's been a little different lately. Look, we're starting to get some readings from some countries, especially Germany. Here's Germany. If you look at this sort of deeper red, we know we've got some issues in Europe because of the war there. But in general, there's quite a bit of green to show that there's global economic activity. I want to show you what I told you last year were going to be some themes. I said we were shifting to defense last year. That was good. I said we have inflation risk. I said that in October of last year. That was right. I said we would continue to have some political risk. I think that was true. And we had valuation risk last year also, and that also proved out to be the case. So I sort of give myself 4 for 4 on themes that I gave to you last year. This year, we're gingerly shifting to offense. Given these rates and valuations, we're sort of gingerly moving to offense. We're deploying cash. If we have clients where people got a bunch of cash, whatever, there was a liquidity event or whatever, we're gingerly moving into offensive phase of investing money. But we're also being wary that we could get some more legs downward. We don't want to hang a bunch of losses on people because markets act weird. I'm a little more concerned about the elections than Scott Orr, just because markets have reacted in the past to divided government this way, that doesn't mean it will in the future. I'm a little concerned. The reason I'm concerned is because if you look at the world, higher valuations persist in places where democracy is strong, and valuations are much lower in places where it's not. Period. It's automatic. The market takes and discounts those countries where laws aren't as strong, guarantees of property rights are not as good, where a dictator can say, nope, that's mine. And Russia's a good example. While Russian stocks were trading in the market, they're not now, Russian oil companies would trade at 2-3 times earnings because investors have to get their money back sooner rather than later, because the longer you go with a guy like Vladimir Putin, the odds go up that he's going to take your money. So, all right, we're still keeping duration short. I told you about the high levels of interest available on shorter term bonds, and so we don't see any reason to get out of that. There's recession risk, but I can't tell you there's going to be a recession. And what we got today, Jack, you asked me about the numbers we got on GDP today. Well, we got a positive GDP number, and so by definition, you know, we're not in a recession. We had 2 negative periods before this period. So the idea that we now have a recession now going on is not so. We had a positive GDP print this morning, but the risk remains that we could see it. And Kurt Riemann really spoke to that when he said, you know, the Fed is going to, if they need to, induce induce a recession if they have to stop inflation.